Hey everyone, and welcome back. Now today I wanted to talk about the future of Bitcoin, and if you enjoyed the information in this video, please do give me a like and subscribe. It really does help the channel out. Now let's go ahead and dive right in. Now today I want to talk about something a little bit different. This is the future of Bitcoin and what this could potentially look like. As we can see over the past couple of years, Bitcoin dominance was really high, and then we see it go all the way down to about 40%, where it stayed kind of level over this period of time. And then as the market started to crash, Bitcoin dominance has continued to steadily rise. As we can see now, we're at about 57%. This is 57% of the total market cap of all cryptocurrencies. So it's very easy to tell that Bitcoin is the 800-pound gorilla in the room. What Bitcoin does, the entire market will follow. So something that's kind of interesting to me that I've been thinking about over the past couple of weeks, well, really ever since the halving that we had back in April, was what is the future of Bitcoin look like 1, 2, 3, 4, 5 halvings out from now? Because one thing that we need to always consider is we need to consider the ongoing dynamics of Bitcoin. What this means is that we need to consider who are the people that secure the network and essentially keep it safe from getting hacked. Well, this is the miners. The miners are always going to need to be profitable, or else there's going to be no reason for them to continue mining. Now, the less profitable it becomes, the more miners will leave the space. And when we have fewer miners left over, then it becomes easier to essentially mine the network, which means it could potentially become easier for a hostile attack on the Bitcoin network. So this kind of creates a chicken and the egg problem, where we see if this network is a $10 trillion network and it's got a massive store of value, then theoretically the mining incentives for miners need to be very high to have a very high and distributed stake of miners coming in. Otherwise, the lower the number of miners and the higher the concentration of miners, the easier it is to carry out an attack on the network. And the more valuable the network is, the easier target it becomes over time, right? So this is something we always need to be paying really close attention to, which is what is monthly miner revenue and what is it trending like over time? As we can see on this chart, we can see that actually the miners' monthly revenue has actually gone fairly dramatically up ever since the inception of Bitcoin. One thing to note also here is that this chart is logarithmic, so we can see that the gap between 10 and 100 is also the same gap between 100 and 1,000. So what we can see is even though it looks steady, this actually somewhat indicates a bit of an exponential growth curve because of the logarithmic scale of the chart. Now, the other thing we need to consider here too is the mined Bitcoin. Obviously, we can see that the mined Bitcoin has been going down over time because as halvings occur, the amount of Bitcoins emitted into the network decreases by half. As we can see recently, the miners' revenue has actually dropped fairly dramatically, peaking right before the halving. This obviously is not super surprising because you would expect, if the price is 60,000 this day and 60,000 this day, but the price of the network, or the amount of Bitcoins emitted drops by half, it seems reasonable that miners' revenues would go down by half, right? Now, what we need to consider currently is the halving rewards per block is still 3 1/8 Bitcoins, right? Now let's go out 2, 3, 4 more halvings from now to the point where maybe the total rewards emitted for a Bitcoin is half a Bitcoin, 3/4 of Bitcoin, somewhere in that range, right? At today's prices, that would be somewhere anywhere between $30,000 to $45,000 for mining a block. That currently is obviously way less than the power needed to mine the network, and so obviously the amount of revenue generated makes it unprofitable for most miners, which then means a lot of miners are going to be leaving the network, which then makes the hash rate easier so Bitcoin can still be emitted on its predetermined schedule. Because ultimately the goal of Bitcoin is to have a block mined about every 10 minutes. And so if there's 10 million people trying to mine a block, then obviously the block is going to be much harder than, let's say, 3 people trying to mine a block, because ultimately the goal is to adjust the difficulty accordingly so a block is emitted about every 10 minutes. So one thing that we need to consider here is, unless we see, essentially Michael Saylor levels of, prediction and price, which would be $1 million Bitcoins, $10 million Bitcoins, $50 million Bitcoins in some estimates, we've got a really big problem here in the sense that the miners are not going to be able to either keep up today's demand or even continue to grow their demand over time in terms of producing more mining power, advancing technology, essentially making the network harder to hack as it becomes more valuable. Because if the network becomes more valuable, then obviously, the value of Bitcoin is going to go up. But if the value of the network does not go up in correlation with the difficulty of mining, then we have an issue here. This is where I think something that people are not talking about, or maybe is little talked about, is the presence of Bitcoin layer 2s. Now we'll get to this here in a second, but one thing I want to show is another chart here, which is the fees as a percentage of the block reward. As we can see previously, the fees as the percentage of block rewards were relatively low. However, we get to this point in time where we can see that fees consistently, as an average, are a lot higher than what they used to be. Now, for those of you relatively involved in the Bitcoin network system, you would know that this is when implementation of inscriptions came out onto the Bitcoin network. And as we can see, inscriptions have, in some cases, had a very meaningful impact in the miners' revenue as they're mining blocks. Obviously, it's not as consistent as what we might want to see it be, but it is definitely over time making a lot more of a meaningful impact here. So one thing that we need to consider is, well, why are we not talking about this more? And could this be a way in which we could help augment the miners', essentially the lost revenue from the halvings? Could we help implement or augment some of their revenues with essentially transaction fees, right? Now, there's a lot of different ways that this could work out, but I think one of the main ones would essentially have Bitcoin become an Ethereum-like layer 1 structure with a whole bunch of different layer 2s on it, essentially creating very low volume but high value transactions to essentially help secure the network, right? This, in my opinion, does not necessarily fly in the face of Bitcoin's core purpose, which is to be a store of value, but in a sense it actually could help that case because there's more money being circulated in the network, which essentially makes the network more valuable, and more miners are going to want to contribute to keep the network safe. So if we look at this next chart, so what we can see here is that we have network to value transactions. What this is a ratio. So the way that we can think about this is the higher the ratio, the more overvalued the network is. So as we can see here, at least historically over the past 3 years, we can see that actually based on this chart, the network looks fairly overvalued. And that's because we've seen a fairly large run up in price of Bitcoin, but respectively, we probably have not seen the value of transactions either go up much, or maybe they've even gone down in certain cases, like maybe over here. What we can see, this is essentially running up to the halving. This is when ordinals and inscriptions on the Bitcoin network were very popular. We could see that the value of, or the ratio on this network value to transactions actually comes down because we're seeing a lot more value being transacted on the network, even though the price is also going up at that same point in time. So this is actually what we would want to see for the health of the network, because that means that essentially there's more value being transacted on the network, which is making the ratio lower compared to the overall value. Because if the value of the coin continues to go up, the number of transactions on the network, or the value of the transactions on the network, continues to go down, then this ratio is going to get even higher, which I think could serve as a bit of concern to some people, because again, the fees from these mining rewards are essentially non-existent, and it's going to be the block emission rewards that have to essentially sustain miners. If the price of Bitcoin continues to rise parabolically, then of course this becomes less of an issue, right? But if we don't realistically think that we're going to be seeing, a $5 million Bitcoin, in the next 10 or 15 years, then we need to have some sort of other solutions that can help essentially stabilize the long-term health of the Bitcoin network. Because if we can't, then frankly, I think the Bitcoin network is destined to collapse, because the miners will not essentially see the value in securing the network. And then if the network becomes less secure and potentially, a hostile attack is carried out on the network, well, then the store of value that everybody claims Bitcoin is not actually a store of value anymore, right? It's actually a point of weakness. So this is something that I think we should really be looking at a little bit more carefully, that people aren't necessarily talking about at this point. So to give a little bit more context into Bitcoin layer 2s, I want to kind of discuss what they are, what they do, how they work, things like that. So we can see here, crypto.com has a really nice write-up on Bitcoin layer 2s overall. I want to just focus on this chart that they have right here. But if you are interested in learning more and want to see more about them, I'd recommend you come to this article, because I think it provides a pretty good, overall high-level introduction into Bitcoin layer 2s and generally how they work. So what we can see here is as of the time of this writing, we can see that there are about 4, I would say, fairly large Bitcoin layer 2s. As of this point in time, I would say there's actually probably another 3 or 4 that are quickly establishing a fairly good name for themselves in the ecosystem. And so, and I would imagine that we're going to see a lot more layer 2s come to Bitcoin as well, because as we can see in Ethereum, I mean, there's several dozen layer 2s in the Ethereum network. And that's because the network is valuable and people want to try and take a piece of the value being transacted on that network. Well, Bitcoin is 5 times the value, I think, roughly of Ethereum. So, I think this could be an even bigger opportunity than what the layer 2s are seeing on Ethereum, because the liquidity in Bitcoin is multitudes deeper than it is in any other chain or any other ecosystem within crypto. So I do think that this could be a potential area where there could be a lot of opportunity to have some pretty outsized gains and also see a lot of value being created. What we're seeing here is all essentially kind of a compare and contrast over these main different networks within the Bitcoin ecosystem. I would say Stacks and Rootstock are probably the 2 most popular at this point. The Lightning network is essentially just for payments only. So it's purely to conduct payment transactions on the Bitcoin network. Stacks and Rootstock, I think, are trying to take more of an Ethereum type approach where, smart contracts are allowed, EVM compatible operations are allowed. They're essentially trying to make them like a layer 2 that you might see on Ethereum. So this is something that, I think is definitely worth looking out for, because if we see the level of transaction and the level of liquidity on Bitcoin as we see on Ethereum, but 4 or 5 times larger because it's on the larger network, then the amounts of money and value locked that we could see within some of these layer 2s could be very substantial. Also, like I said earlier, I think it could be better for the Bitcoin network long term because it's helping offset the decrease in halving emissions with increases in fees for the miners. The other thing that is causing a bit of a holdup for certain layer 2s within the Bitcoin ecosystem is this coding function called OPCAT. Now, this was a coding function that was in an earlier version of Bitcoin, but Satoshi Nakamoto actually removed it from the network because it essentially was too open-ended and too powerful. And part of the goal of Bitcoin essentially was to be, kind of dumb but reliable, right? The dumber you make something, the easier it is to keep it safe, and there's less unforeseen consequences. This is something that's kind of like a current point of contention within the Bitcoin network, is because a lot of people who are the Bitcoin maxis think Bitcoin is fine just as it is, and it doesn't need any sort of changes or improvements or anything. But then you have the other people who are wanting to build out the layer 2s on the network, who are needing some of these more expressive functions to help them build out Bitcoin and help essentially facilitate more smart contract abilities within the Bitcoin ecosystem. So anyway, I just want to bring this to you today because I think it's something that people really aren't talking about, but it's something that is actually really interesting if you start to zoom out and think really long term about Bitcoin with, where could this go? What does this mean? How does this work longer term for people? So anyway, if you found this video useful, please do give me a like and subscribe. It really does help me out. I also make daily videos, and so if you have any suggestions or anything you'd like to learn more about or see further, please do let me know. I do read all my comments, and I would love to hear from you guys if you have any sort of questions or anything you want me to go over. Anyway, thank you for tuning in, and we'll see you in the next video.